Okay. Now we have a conversation around the cash flow. Now, the cash flow of a business is the cash inflow and outflow over a period of time of cash flows. The cash inflow refers to the sums of money received by a business during a period of time. And the cash outflow are the sums of money paid out by a business during a period of time. Right? I repeat, cash inflow is the sums of money. These are the sums of money that are received by a business during a period of time, and cash outflow are the sums of money that are paid by the business during a period of time. Okay, so that's what cash inflow and outflow is. So all in all, we call them generally as just cash flow. So we want to have a conversation around the cash flow forecasting and the working capital. It is a requirement that at the end of this conversation, you should be able to tell us the importance of cash flow for business operations. You should be able to tell us how a cash flow forecast is constructed and how it can be amended, how firms can run short of cash, and actually the likely consequences of the same. How a short-term cash flow problem can be overcome, and the importance of working capital. All that is very important and you need it. So let's start answering these units by, these key points by looking at why cash is important to a business. It was indicated that cash is actually a liquid asset, implying that it is immediately available for spending on goods and services. It is immediately available for expenditure on goods and services. So, do you ever run out of cash? Then if you run out of cash, then you will not be able to pay for the goods and the services. And that's very clear, right? We are always aware that once we run out of cash, we will not be able to, pay for the goods and the services. So cash is very important, and we need it to pay for expenditure, for expenses. We need cash in so many ways. And again, if the business has too little cash, or even maybe runs out of the same cash completely, it faces a lot of major problems that could include being unable to pay workers, being unable to pay suppliers, being unable to pay the landlords, being unable to pay the government, that's taxation. So you see that once you don't have enough cash again, production of goods and services will stop. And as a result of the same, the workers will not work for nothing, and suppliers will not actually supply if they are not paid. So the business may be forced into liquidation, that is to say, selling up everything it owns to pay the debt. Okay, so from the few lines that we have just read and communicated to you, it shows that cash is very important. And by cash, I do not just mean non-current asset or the current assets. I'm referring to cash that is available. We're not referring to receivables this time around. We're also not referring to inventory. We are not referring to prepayments. We are referring to the actual cash That's what we are discussing. So cash is very important. You need cash in business to pay your workers, suppliers, landlords, and government, among others. In short, to make payments. You need cash to support production processes, and cash is needed so that the business does not go into liquidation, which is a situation where the business sells up everything it owns to pay its debt. Okay. So now let's ask ourselves what is meant by cash flow. So there are there are two forms of cash flow. As I said, there is the cash flow that leads cash into the business. That's called cash inflow, and cash outflow, which leads the cash out of the business, or it involves cash flowing out of the business. Now, the following are some of the ways, the most common ways in which cash can flow into the business. So if you're asking, what are some of the common ways in which cash can flow into the business? The following should actually be included. Number one, the sale of products for cash. You can sell some products for cash, then you can receive cash. The debtors, the people that owe you as a business may pay. So those payments that are made by debtors, right? They can make us receive cash, and we can borrow money from external sources. Maybe get a loan or something. That's still cash inflow. Or you can dispose of the non-current assets. For example, the unwanted, property. You sell those non-current assets. As you sell them, you receive cash. Or the same investors, they are able to give money to the company. So these are just some various ways in which cash can flow into the business. I have said number one, you can sell the product for cash. Sell whatever you are selling, then people give you cash. Okay, that's one way in which cash can flow into the business. Sell. Or you can have your customers pay, like those that owe you, the debtors pay you back. You can have them pay you back. You can have them pay you back. Or you can borrow money from external sources. That is borrowing money, get the loans, among others. Or you can sell the non-current assets. And you can have your investors invest money in you. So basically, that is what is there. Is that clear? You guys, do you have any question?
No.
Okay. If people do not have any question, that's right. So now we now consider the common ways in which cash can flow out of the business. We have talked about how cash can flow into the business, but how can cash flow out of the business? That's important. What are some of the possible ways we want to discuss? Arush, what do you think? What could be the possible options on how cash can flow out of the business? Mm. Right? We want people to discuss the possible ways on how cash can flow out of the business. You cannot be quiet, you guys. Drew, what do you think? How can cash flow out of the business now? Yes, Mr. Paul, your hand is up. Go ahead.
Paying of rent.
Right, so you can make payments of rent. Thank you. Drew, what do you think?
Sir, by purchasing goods.
As you are purchasing goods, you can have cash flow out of the business. Maria, what do you think? How can cash flow out of the business? Any possible ways? Right. Zahir, what do you think? Okay. So there are various ways through which Paul has the hand up. You can go ahead.
Purchase, buying purchases.
Okay, through the purchases. Thank you. So usually cash could flow out through the purchases of goods and materials for cash, paying wages and salaries or other expenses on cash, through the purchasing of the fixed assets. When you're buying the fixed assets, yeah, if you happen to start buying the fixed assets, so that way cash can flow out of the what? Out of the business. Or sometimes if you have a loan, okay, if you have a loan, then cash can flow out of the business through a loan. If you owe your suppliers, you have to pay them back. As you're paying them back, if you pay using cash, then cash will flow out of the business. So by purchasing materials for cash, by paying wages, salaries, among others, and by purchasing the fixed assets or the non-current assets, by repaying the loan and paying the creditors, those are possible options. Actually, those are some of the possible options by which cash can flow out of the business. Okay? We have this simple activity to look at. It's a very simple activity. All you need here is to tell whether this is cash inflow or cash outflow. And so I will point at you, and then you have to tell us. We start with the first one. This is a simple activity that we have in the group. Very simple activity. So number one, we have the purchase of new computer for cash. The purchase of new computer for cash. Zahir, what do you think? Is this cash outflow, cash inflow?
Cash outflow.
Right, thank you. So this is cash outflow because you know that a new computer is a non-current asset. And we said, the purchasing of non-current assets lead to cash outflow. We have sold goods to customers, no credit given. That is to say, on cash. A sale of goods on cash. Drew, what do you think this is? Cash outflow, cash inflow? Okay. Prit, what do you think this is?
So it's inflow.
Okay, thank you. So whenever you sell on cash, you receive the cash. That's cash inflow. The interest paid on bank loan. Now we find out from Maria. What do you think this is? Maria, is this cash outflow or cash inflow? Okay. What does, who is ZH? What do you think this is? Now you got to answer the questions so that you can have your image protected. Arosh, what do you think?
So cash outflow.
Why, thank you. This is cash outflow. Okay. Then we are paying wages to employees. What does Paul think this is?
Outflow.
It's an outflow. We pay debtors their bills. That's an outflow. Okay. Pretty, what do you think additional shares that are sold to shareholders are? Could that be a cash inflow or outflow?
So cash inflow.
Thank you. So this is cash inflow. Okay, the cash is flowing in by that. We have also the creditors that are paid. When you pay the creditors, obviously this is cash outflow. You're aware. The bank overdraft that is paid off is still cash outflow. So that's basically what happens. Progress. You see, the diagram below will help us to explain the link between some of the inflows and outflows mentioned above. And so the cash flow cycle, it is called. So it explains why cash paid out is not retained immediately into the business. And this is what we want you to understand. This is called cash inflow cycle. Number one, cash is needed for, to pay for something. Number one, you need cash. Okay. Cash is here, is paid for wages, for rent, and for all those expenses are made, right? Then the goods are produced. After you have produced those goods, remember, so your cash from the time you needed to pay for whatever, it moved out of your hands and you paid for those things. Then those same things made you have the goods produced. Have these goods produced here, and the same goods that have been produced, you sell them. So we have these goods sold. They have been sold. After they have been sold now, you have to sell the goods that have been created. That's when you have the cash that will be received from the sale of goods. So in short, it takes time, right? There is the time that it takes. And this is called cash flow cycle. So there is the cash, then you make payments for those, you meet some expenses, have the goods produced. After the production cost, you have the goods produced. Those goods that you produce again, So there is time that passes in between all these lines. There is time that passes. Okay. From the time you pay for the cost of production up to the time the goods are fully produced, there can be some time that passes in between here. And again, from the time you produce the goods up to the time you sell them, there could be some at times maybe months here in between before you sell those goods. So once those goods are sold again, you receive cash, and sometimes the goods are sold even on credit. So which will even lengthen the time period here again. So in short, there is a lot of time lag, time that passes in between the cycles. Okay. So you have the time that passes in between. Okay. Having said all this, then it is necessary for us to go ahead. Yeah, it's necessary for us to go ahead. You see that the previous diagram helps us to understand the importance of planning for cash flows. We ask ourselves questions such as what would happen really? For example, if the business did not have enough cash at stage number 1, that is enough cash to pay for expenses, they would not have enough materials and other requirements that could be purchased. And so output and sales would still fall down. A business insisted on its customers paying cash at level 4 because the business was short of money. It might lose the customers to a competitor who could offer credit. So this is what happens again. If at stage number 4 here, after you sell the goods, you just say, okay, we are just selling on cash. We don't want credits. You know what that means? That means some of your customers will say, okay, no, these guys are not serious. We'll go where they are and they are more understanding. You lose your customers. So there are all those issues that needs to be brought to your attention. Now, a business has insufficient cash to pay for the bills such as rent, electricity. So it would be in a liquidity crisis and it might be forced out of business. So if it doesn't have enough cash to meet all these expenditures, the business will go through pressure and it may actually be liquidated because it is unable to meet the immediate expenses. Now, sometimes these same businesses do fail. If a profitable business runs out of cash, then the business is bound to fail. So now, if the business runs out of, fails or runs out of cash, that is called insolvency. It is called insolvency. It is possible for a profitable business to make losses through the following possible ways. Number 1, possible for this business to make losses, because it can do this by allowing customers too long a credit period, perhaps to encourage sales. So if the credit period is too long, like the time period that passes before your customers pay back is just too long, then you are in problem. Okay, there is a challenge there. Or if they are purchasing too many fixed assets at once, like they're using all that money they have to just buy the fixed assets, they'll run out of cash. And again, if they're expanding too quickly and keep a high inventory level, so they're keeping too much of inventories as well, that would still make them run out of cash. I said you may run out of cash as a business if, number one, you allow the customers a too long credit period. Like the time that passes in between before they pay you back is too long. If you are just using your money to acquire just more of the non-current assets instead of, buying, or instead of keeping the cash, or if you want to get too much of inventories, all those things can make you run out of cash. So cash is always needed to pay expenses. To summarize, cash is received from customers, also from bank loans and sale of assets and shares. Cash is the most liquid asset. Lack of cash can lead into the liquidity problem. That is a problem where you don't have enough, cash, and you can't manage to meet the day-to-day expenses. And cash flow is not the same as the profit. That is what we indicated in the previous slides. Is there any question? Is there any questions? Okay.